Good morning, good afternoon, wherever you are. It's time for another thrilling monthly session of On the Offense. I'm David Foster, the CEO of BBR and a devout renewed member. Our association is hot off the success of our first conference last week. So today I'm lucky enough to be on, and we've got the tough job of trying to keep the momentum going. But I think there's both Ian's background, which he'll tell you a little bit about, at IHS Markit and at Informa, two of the hugest brand names. Also, Ian took some time to pursue his advanced degree at London Business School while he was doing all these other things. And out of that came a research project that is the subject of today's talk. You know how much attention business school projects normally get, which is about zero. But this is extraordinary research Ian did. And the only, maybe it'll show up on the front page of the FT, but the only place I know it's being discussed is here. So this is really some exclusive research that Ian worked very hard on. So I'm really, really thankful, Ian, to have you join this discussion today. It's really nice. So maybe just to kick off, obviously IHS Markit sold to SPGI recently, and Ian, for whatever reasons, you decided to try a different path. Do you want to just update all your friends here on what you're doing right now?
Yeah, absolutely. So, I've been with the agribusiness division of Informa that was then carved out to IHS Markit for 20 years.
Enter your participant ID followed by pound. Otherwise,
Sorry, Rich Haydorn, could you mute?
You are in the meeting now. There are more than 20 participants in the meeting. This meeting is being recorded.
This is second time in a row. Rich, could you mute?
Oh,
thank you. Go ahead, Ian.
Yeah, so I've just completed the executive MBA, and I really felt that a lot of the skills that I've learned and built up over 20 years, I wanted to apply in a kind of a more direct way to a small business where you can have a bit more impact. So this week I joined Aspermont. Some of you may know it, been through a little bit of a turnaround, but does listed information in media in the mining sector. So joined as Chief Content and Strategy Officer. And, it really was about kind of feeling part of quite an experienced executive team and going into an SME where I sort of could really see that they're making a relatively low amount of revenue now, and could really see many different initiatives where you could drive the whole company's success. And so quite amusingly, I was talking at the publishing show about how to get close to customers, and small publishers should really kind of drive product development on that basis, and high value subscriptions. And someone in the audience asked me, yeah, it's all right for you in IHS Markit with all your resources. And I sort of said, well, actually the principle doesn't change. If you uncover customer value and build out in an agile way, then you can do that in any environment, small or large. But of course, I'm now in a position where I have to sort of prove myself right on that point, walking the walk.
Yeah. Good luck. Good. I'm sure you'll be a success, and it's certainly what you're doing now aligns your problems and solutions with everybody on this call and the bulk of renewed members. So you're solidly down in the trenches with all of us at this point. Could you give us a quick description of the huge research project you took on at LBS, who you interviewed, who was involved? Just a real quick description so people understand the data set you're talking about today.
Yeah, absolutely. So within my career, I've been quite interested in acquisitions, and from both sides of it, from being kind of moved from Informa to IHS Markit, but also acquiring small companies. But really, I'd only worked on a handful. And I really wanted to get a sense of the motivations, the processes, the ecosystems, best practice, and just the reality of selling and buying small businesses in sort of the information and media sector. And so it's become a bit of a living project. Every time I was speaking to a new person, it adds into kind of my knowledge and into this research. But at the point where I sort of submitted this project, I'd spoken to over 30 people who, some part of the Renew community, all of whom, had such amazing experiences beyond mine. And so I sort of have to recognize them as I'm just this sort of collator of this information. But I guess they broke into 3 different groups, and I was looking at slightly different things. One group was the sort of SME or business owner or CEO who either would have to or had exited their business. And there I really wanted to get a sense of their motivations to sell, I guess things like the level of preparedness, what went well during an exit and what didn't. The other part was, I guess, coming from the corporate background, I was able to access kind of VPs or CEOs or corporate development staff in listed or large acquisitive business. And so many of those had sort of gone through both the buy side and the sell side. But, for them, it was, again, kind of looking at what went well or not during a deal process, and not necessarily from a statistical kind of point of view, but actually from a gathering up, the sort of the anecdotal evidence and things. And then, of course, there's a big kind of part of this ecosystem is there with bankers, brokers, consultants, and so on, who sort of, I guess, gave a slightly independent view of these transactions.
Yeah. Well, for all of you on the call, if you think of those 3 groups that Ian just described, I would throw in my usual reminder that we're all together on the Guild network, and so many nuances in Ian's research. I've had the opportunity to talk with Ian several times about this. We're not going to get to all of them, but if you think of those 3 groups, there may be questions each of you are interested in, and I challenge you all to reach out to Ian after this call to hear what else he's learned, because I think there's some really strong guidance. But I think for today's session, the stuff you learned about what adds value and what takes away value, either it could be new product development, but in your case, it's mostly acquisitions. You looked at a lot of what succeeded and what failed. But so that's going to be the bulk of what I think we should talk about. But before we get there, the first group you mentioned was the business owner, the SME, and there are a lot of people who fit in that category on this call. And as I understand it, you identified 2 very clear camps on the seller side, and 2 very different strategies that were required depending on which camp you fell into. So just to start off, would you mind just discussing that quickly? And because real lessons for all of us in this point. So
yeah, I think I think everything's on a spectrum, right? But there were sort of 2 clear ends of that spectrum amongst kind of owners, and at one end of it was, kind of owners that were really actually building their business over the medium and long term, to kind of sort of planning ahead in how that they were going to want to exit this business. And, sometimes that was thinking around things in terms of, right, actually, who are my likely candidates that I'm going to sell this business to in the future. You know, down to, in some instances, being pinpoint. You know, I'm almost kind of building this for one potential acquirer. You know, and you know, certainly I think that depth of planning, you know, enabled these people to make sure that they were continually thinking, am I building this not just to grow the revenue, or you know, to do the elements that I want to, but also to maximize the eventual you know, kind of sale of the business when I, you know, get my earnings and my multiple, you know, and that's I guess kind of at one end of the extreme. At the other end of the extreme, I guess, you know, there was elements where, you know, this has just been my business, and I'm running this to kind of ensure that I continue to grow it. You know, I have motivations that are beyond financial, that are, you know, looking after my staff. This is the lifestyle that I want to. And then you sort of come towards the sort of a reason to sell, which might be retirement or health reasons and things. And you know, at that point, it's kind of more sort of, I guess, kind of as a sharp realization that it takes a considerable amount of effort and a lot of, you know, kind of challenges, lots of processes, things you wouldn't have necessarily thought about in your day to day to actually.
Well, they could certainly do that, but I also think there's probably a plug-in.
William, mute. Thanks. Ian, go ahead.
Yeah, so you know, those were a couple of the ends of the spectrum, I guess, and you know, and I think one of the things that I took from it is I don't think necessarily either were wrong, right? Because if you almost spend too much time thinking about you kind of the exit and planning for that, and that, well, will you actually get the growth that you want to, or maximize the growth out of the business? And so, you know, it was clear that when it was sort of like actually planning for this exit, getting actually the right advisors in certainly appeared to be, you know, quite important in terms of, you know, being able to be, handheld might be too strong, right? To be guided through what is a process that you may only ever do sort of once in your life, twice in your life, but you know, is you know, deal making can feel like almost kind of more of an art than a science. Certainly, it's got a lot of human elements into it, and you know, kind of people were telling me about, you know, the near misses, the number of times that deals didn't go through, and often that was less about you know, specific kind of financial things or whatever. It was actually about the relationship between the buyer and the seller.
Yeah. Would it be fair to say, I think you described to me the part of the reason, if you're on the, I guess I'd say, less planful side of the seller spectrum, the second half of what you described, it seemed to me that your research showed that you were more likely to have conflict, perhaps lower values, fights with your lawyers. All of the friction around a transaction was much more likely to occur if you were on that end of the spectrum, as opposed to being on the build your business, like, for instance, you know, the way Robin, who's on this call, Robin and Victoria, obviously built a business with one seller and one buyer in mind. Is that true, that selling is just plain going to be harder, more likely to fail if you're on the less planful end of the spectrum?
Yeah, I think it'd be tough to conclude that overall, you know, because you know, many people who were sort of you know, arriving later at that kind of realization that this is going to be a deep process, there's going to be a real kind of involvement. But it still had, or at least the people I spoke to, still had very good, you know, kind of exits. You know, I didn't sense or didn't speak to anybody who was kind of like, you know, yes, I exited, but I think, you know, in hindsight, actually, you know, I was well below on my valuation or anything like that. I think, you know, what did show is the more that you know, kind of you can prepare for it, actually the easier you will make your kind of life. And I'll give a few examples of that. So you know, one example wasn't actually in the media space, but actually you know, this person kind of went through one sale process and was just kind of like, he just really found it difficult. There was a lot of tension. There was a lot of scrabbling around to find contracts from here and everything for like that. You know, ultimately exited, and that was great. He then built a second business, and you know, it was growing very rapidly, and got an opportunistic kind of offer after 2.5 years. When he first started that business, his sort of business partners were, you know, kind of, you know, I'm trying not to say take the piss, but I can't think of another word. We're mocking him for, you know, for how the degree to which he was ensuring that everything, we knew where everything is, everything was signed, everything documented, and everything like that. The way he described it was, you know, though, when they got this opportunistic, you know, offer, he was the one laughing because they were in such a good position to go through due diligence and be able to say, look, yeah, here it is, yeah, we can conclude next month if you want. And that meant that he was able, in his view, to ensure that there was no eroding of that kind of valuation and that multiple that had been put in there. And so, you know, it'd be hard to conclude that, you know, that you're eroding it kind of valuation or putting yourself at more risk, but clearly a bit of additional planning, provided it doesn't affect the kind of performance of the business, is going to put you in a better negotiation position.
Gotcha. Thank you. Well, let's move on to the question of value. And here we're talking about a lot of the questions you asked were about acquisitions, but I think your research holds for any new initiative where there are, you know, there's new staff involved, there are new financial resources invested, any transformational change. So even for those of you on the call who aren't planning on selling or buying in the next 15 minutes, I think, well, could you, let's start with the things you found, like what were the signs that a transaction was going to succeed and add value? You know, yeah. Start wherever you want on that one, because I know you have a lot of conclusions there. So
yeah, but you know, I mean, I know I'm trying to sort of go through a number to give a sense, but you know, I mean, first of all, from a buyer's perspective, you know, it's about buying at a reasonable or a low multiple, right? Because then you're kind of starting in the right place, and you know, every business can be sort of.
Todd, I think you got some feedback on your line. If you mute out, Todd, sorry. Go ahead, Ian.
Yeah, so you know, every business will be kind of valued differently, and who's buying will make a difference to the valuation. But essentially, if you can buy, you know, because of a very strong relationship, or because it's proprietary through your network, or it's a divestment from a corporate, you know, in sort of a sense of a management buyout or whatever, you know, and you know, you can start off at a lower base. Clearly, that is going to you know, assist you. So being well informed at the point of negotiation, I feel was kind of vital to be able to build the value.
Yeah, I think that point just strikes me as incredibly noteworthy. Not because I'm suggesting that buyers try to be what we'd call bottom feeders. But because the fact, I guess if you're a private equity firm and you have tons of capital, you assume that 9 out of 10 of your deals are not going to work out, and you're looking for the huge success that carries the rest of them. So you can maybe in that market afford to overpay. But you're saying that your research showed that the surest way to succeed, or one of the surest ways to succeed, is to pay a fair price, not pay an inflated price, because that just puts a burden on a transaction of up to.
Yeah,
Is that a fair summary?
Well, I just clarify. I think your sort of portfolio 9 out of 10 failures. That's more sort of in the VC world, kind of the real startup. I think, and you know, there's some people here who've worked directly with private equity. I feel that actually they're very disciplined buyers, right? Unless they're getting to the point where their fund is, you know, kind of 5 years in and they haven't acquired enough. Companies, and they may lose their discipline a bit. Really, actually, they are very strong financially, you know, when valuing the companies. Where I've seen it more often that, you know, there's been this kind of bidding price upwards to get to the winner's curse is actually within listed companies, because listed companies, unlike private equity, can typically say, oh, we're going to get synergies here and, you know, cost savings, revenue growth and things. Yes. And there tends to be this, oh, it's really strategic, we really need this, we need to get into this. And they convince themselves that they can overpay for something that may be hard to work out in terms of your plan. And so, you know, I think that there's, you know, but bottom line is, you know, that most of a number of the cases where people were saying these were bad deals, it was at that buying point where actually they sort of had, you know, overpaid for different reasons.
Yeah. You sort of mentioned, I know we started out with the topic of what unlocks value, but you sort of led into a second area that you and I discussed, which was these, like, I guess what I'd call fanciful belief of synergy or something like that. And, you know, having been seduced by that at various points in my career, maybe I'm just ultra sensitive to that topic, because I know I can tell myself great stories about how two things fit together perfectly well when everyone else on the planet sees them as that's a circle and that's a square. They're not going to fit together. Could you talk about some of the things you learned about that mistake and how things went wrong?
Yeah, I mean, in terms of generalizing that, I think, you know, first of all, it's about building kind of a very clear plan of where you are going, and you know, that can include cost synergies. It can include very clear, you know, revenue growth, you know, around whether that's going to come from price rises and cross-sell and upsell and product improvement, or whether, you know, it's going to be actually developing new products out. And a very strong theme that I saw from different people was actually, you know, some of the traditional publishing businesses that were bought and working towards, you know, products that are more data and workflow tools, which have a higher multiple for that revenue when you exit. And these can be kind of both ways of generating value or ways of undermining value. For example, I spoke to a CEO who was saying, you know, when they were investigating their sale process, it was CEO of an SME, that, you know, he had, and he was still a year or two out, as I recall, he was, you know, realizing that his push into consulting was actually going to undermine the potential value of the business. Yeah. And so realizing that, started actually shifting away from the kind of the lower multiple revenue and shifted strategy towards one that will bring a kind of higher revenue. Yeah. Or a higher multiple.
No, that's a great example, and it sounds like you're sort of like your survey can confirm that there's sort of a hierarchy of multiples on the kind of products we should be focusing on a little bit, which I know that's always a dicey topic, and it's, it can change depending on the whims of the investment community, but still data seem to come out near the top in your research.
Yeah, I think that's true. Just because if you're selling to sort of a financial player who's just looking at quality of earnings, the difference would be is if you are looking for an exit to a trade buyer, where actually you're building something that is just going to fit hand in glove with what they're looking for. There, that's actually it's. You sort of only sell it to one person, and if that is the company that will pay more than a financial buyer, then then there's a sensible rationale to be building your business in that way. And so yeah, if you have a sense of where you're building it for, that's gonna be an important one. I think moving to, I guess, kind of some of the execution failures, I guess, that we I heard about, which is the flip side of, how do you grow the value? There were numbers of instances of sort of key person exit, and that is anything from sort of leaving in bad faith and setting up kind of, a competitive organization to it, instances of people leaving and, taking their customers away from them, or even just because they are so important to the IP and the content that's being produced, that either an individual or some staff drain that don't like the new culture can actually really undermine kind of best laid plans, right? Because these were the people that were driving the value in the original business, but once acquired, actually, the new ownership, it can be a different culture.
Yeah. We all talk about cultural fit, but I get the sense that your research sort of fleshed out what that means, and perhaps how damaging it is when maybe just a few people aren't on board, or that really is, it's not a cliche. It really is one of the most dangerous parts of any sort of transaction.
Yeah, absolutely. Culture is a really big element, and I was part of Informa when they acquired the Data Monitor business, and there is an example of where two very different sales cultures, very different business cultures kind of came together, and it was an acquisition that was kind of in the hundreds of millions. There were some elements where it became integrated in a way, but there were other areas where it was the businesses just didn't fit together, it wasn't working with things. And for anybody who knows the story, eventually, a big chunk of that business was sold back to, Mike Danson and what's now Global Data, for a considerably less kind of, number on that. And, it's not solely culture, right? But, culture will have added to the difficulty in terms of bringing these information sets together.
Yeah, maybe just a last question, and then we can open up for some of the questions that are coming in, Ian. But one of the other things you commented on to me, where you were, I think, maybe a little surprised to discover how often transactions got off on the wrong foot, had to do with, I guess what you'd call due diligence mistakes or oversights a little bit. And, those have all become more technical or technological and things like that. But the process still requires a lot of judgment and things like that. Could you just quickly talk about how badly you saw that go wrong a couple times?
Yeah.
And then we'll open up.
it was something that I tried to get another deeper understanding on. What does poor due diligence mean? When people were saying to me, it fell down because of our due diligence and things. And there were different things in there, for one example from someone who was in corporate and had bought an SME, essentially they didn't do deep enough due diligence. They were really keen to get into a particular sector. They, bought this business to get into a sector and realized that actually what they thought was recurring revenue, what was strong subscription, was actually just sort of patched together kind of one-time revenue being dressed up as subscription. And of course, that is an element then where you're set back, where you've paid quite substantial multiples for that kind of revenue, and so you've bought, but actually you're also sort of back to square one, where you need to still build a subscription product in this area that you thought you were buying. So that, one example. There's others around, kind of somewhere there were long-term supplier contracts where they believed that they were long-term, but actually when it came down to it, a change of ownership triggered and meant they were exitable. And so either you're without a supplier then, or you're in a position of negotiating. Instances where people or business had acquired another business and believed there was a certain number of customers, but then found that actually these customers were being auto-renewed, and that many of the customers hadn't been contacted in a very, very long time, and really it was almost kind of ghost revenue. And so I guess the message that I sort of took from this is if I was in that sort of acquiring position, as much as you can get third parties to do the due diligence and everything for you, you really, it's so important to aim to dig in and make sure that things are what they seem.
Yeah. Would you maybe I'll let for the rest of this session, I'll let people chime in, but I think you can see, Edwin, you asked a question earlier just about do future market values play a part? I know your survey wasn't primarily about what the values were, but what's your sense? Are people paying for forecasts?
Yeah, so I guess there's kind of two core ways that businesses are valued. What one is mainly around kind of the trailing earnings and or as you mentioned, the kind of revenues, and then putting a multiple on that. That's, I guess, kind of the quick and dirty way of doing it, and is actually sometimes the more appropriate way to value small businesses, certainly initially when there is very little kind of information on them. You talk about kind of the future market value and the kind of the discounted cash flow DCF process. That is used, but I feel that it seems if I talk generally, it seems that is more often used when you've got kind of people that are looking at large businesses, listed businesses, good kind of and there is a lot more data to do that. And even then, it sort of arrives at quite a similar place. And so, private equity can often use the sort of the shortcuts. The other way that people will look at it as well is by finding kind of sort of using kind of benchmarks of other transactions to narrow down that range of the multiples that you're applying to it.
Yeah, I think there's definite. I saw a study that for the FTSE, the big stocks, the Financial Times ratings, during COVID, the price to book value has increased almost 40%. This is for listed companies. But the point is, that's sort of a way of that the stock market values future earnings based on intangibles, I guess. It's like the customer goodwill, recurring revenue, whatever you're making up. But the gap's so big now on that end of the market. And my sense is it doesn't really apply. You still hear the 10 million and above, we start thinking with those numbers, perhaps. I don't know if you agree with that.
And when you're talking about SMEs and the earnings are relatively low, back to my point earlier of actually often it can be about, the multiple is more about what the buyer is willing to pay. Right, because they will have synergies, although I have a rationale for buying this or a situation that's completely different. What the ideal for a small business owner who's looking to sell is actually get that auction process going, right? And if you're then getting kind of multiple kind of people interested in the business and they're putting their own valuations on the business, that's really when you're actually going to find out what the business is worth.
Yeah, I think that's true. Give you an answer, Edwin, to your question. I think at least what I've seen is if people are willing to pay for future value in their forecasts, but not necessarily yours. So if you can get them excited enough to envision a very rich future, people will pay a lot for that. But conversely, if you send them a forecast of, we're predicting 40% growth for the next 20 years or whatever, that's probably not going to carry a lot of water. Go ahead, Ian. Sorry.
Yeah, it's an interesting point because a lot of what some of the owners and of the SMEs were talking about was actually some of the coaching that they had gone through with advisors around actually how to sort of pitch the business, what to focus on, what's resonating and everything like that. And you can actually really tell when, from the buy side, when someone has a management team or an owner has gone to that effort, because you get a sense that this is a credible story. It's a story that's continued, as opposed to when you see some teasers about kind of buying businesses and it's kind of like, well, we've just added 10% growth onto this. And it's kind of like, you've done that to make it look like the growth is going to continue, but actually you're almost sort of forcing the buyer to use his imagination or her imagination around what could this be like and what could they do, and they will go through that. But the more that you can say, hey, this is a great business, and so on, the better.
Yeah, that's a good point. Ed, you asked about what form Ian's research is available in. Do you want to?
Yeah, well, yeah, just Ian, how can we get our hands on your research? Is that possible?
Yeah, so what I'm doing is I submitted a project to London Business School as part of the executive MBA. And I've wanted to make sure that has been kind of included and marked, basically. But what I'm then going to be doing is, pulling together from that essentially a summary that tries to look at some of the themes that I've talked about today, quantify some elements where I can, etc. And then the plan certainly was for all those people that have been kind enough to help me to make sure that they get a copy of that and share it with the renewed community. If I wasn't completing the degree and then finding myself a new job, I might have finished by now. But we'll make sure that can get to people.
I don't know what the highest grade at LBS is, but we just gave it to you.
David, while I'm unmuted, can I sneak in one more question?
Oh yeah.
Ian, you mentioned developing an auction, but I was curious if your research found any indication, is the best way for a seller to generate value? Is it always through an auction? Is it, I'm thinking about, as David mentioned, Robin and Victoria, targeting one seller and aiming at that the whole time. Is it better to have a focused view on one or a few sellers and really, buyers, and really sort of deliver the product that is going to be appealing to them, or to have an auction? Do you have any thoughts on that?
It's a little bit of a tough one, right? I think typically you would find that trade buyers, strategic buyers, because of the synergy, should be able to pay more, and so ideally you would be able to get them in. But of course, there is a lot of dry powder and a lot of desire from the private equity community to buy into really strong businesses, so I feel the best thing is that you should be looking to grow the business to be as attractive to as many parties as possible. Except perhaps in the instance when you really know this will be sort of hand in glove fit and will be a kind of a very easy exit to a trade buyer. Trade buyer will always probably take a degree longer than private equity. Very used to going through that perspective. But it also, I think, what plays into that, and one of the things that I talk to people about is actually, if you're in the fortunate positioning of owning this business, well, actually, what are your goals out of it? Do you want to be selling it to completely exit the business and you really don't care who it goes to? Are you selling it, but actually you want it to remain under the current brand, the same sort of company where a private equity might be better? Because if you sell to a trade buyer, you might be selling to a long, term competitor. They might take it and just kind of completely merge it in. And of course, within that, a lot of owners were thinking about, okay, I may not be here, I might only be here short term, but I want to look after my people. I want to know my people will have a job after that they'll have good career opportunities, and that's, I guess, kind of personal view. It did seem for me anyway that when selling, the owner's motivation, it wasn't generally to live, the first priority was the valuation. How much am I going to get out of this? Financials. After that came some of those other factors that you may or may not be able to shape.
So we're getting near the just a couple more minutes. Real quick answer to Robin's question. Did COVID throw a curveball, to use an American sports metaphor, into this, or?
Yeah, absolutely. So it really depends which area you look at, and I think COVID clearly pretty much stopped anything but distressed transactions in events. And so the events kind of, there wasn't really many transactions, but where they were much lower valuations. It put a premium in the event sector on anybody who was provably, doing things in hybrid and digital and things, and showed that they could have some resilience through that. Moving towards the other end, I think subscriptions were shown to be kind of really resilient businesses through this. And so, the multiples there, and, they range, but, some of the businesses that have been sold, that I know of recently, that are heavy subscription, decent kind of revenue numbers, so more sizable businesses than probably the average renewed kind of SME, they're going for 17, 18, 20 times earnings, which, is historically, that is incredibly high. I think an interesting element to look at is, will they stay so high? you know, at the moment, there's a lot of money that's being pushed into the direction of private companies, you know, because interest rates are so low and, you know, you can't get the returns elsewhere. You know, but there's a lot of money chasing kind of, you know, a pretty finite amount of good businesses. You know, but will that last and continue to last?
Sure. Could I maybe, I'd point people to the chat group comments by Rory and Julian and Robin around strategy here, which hopefully we can continue on Guild after this one, because it's a nuanced question, but Ian's research really helps. And maybe just to sort of stay on time and wrap it up, I might just mention, Ian, that in our discussions about some of your findings, one thing we haven't discussed, but a quick point, Edwin asked earlier about management team orientation. And I know one thing you discovered is in a case where there's an acquisition and the vision isn't particularly accurate, the problem can often be that the management team is trained to do something that doesn't align with what the buyer thought the new plan was. So to Edwin's question, I think the management team can be critical to either the success or the failure, but only if the new management team is aligned with the new vision going forward. That's one point. And another topic that we talked about a lot that we won't have time to get to here that Ian's research showed is the misalignment of earnouts and that chronic problem that, well, now I'm an executive with a new company and I'm incentivized to do A. You're asking me to do B, but I'm not incentivized to do that, so I'm not going to do B. You know, so that's another place where value was taken out of deals a lot. So sorry for the quick summary of a lot of intense discussions you had there, Ian, but if any of you are interested in those topics, I would say continue the discussion after this one. So Ian, your willingness to sort of discuss this and to accept our grading of your project, you know, in very positive terms is a huge gift to the community. So can I just say thank you for sharing and good luck getting it to the finish line. And also great good luck with your new having an impact career step away from the big guys and down into the trenches. So I hope that goes well.
Yeah, thank you. And I just have to reiterate my thanks back to the community, you know, and those people who have been through this, because, you know, I'm highly conscious this, you know, this is me talking about many other people's journeys and kind of all of that experience. So, you know, thank you to them. Yeah.
Thank you. So once again, thanks to everyone for continuing to be active in Renewed. We've got a full program next month on the offense. We're doing a joint program with Collingwood on management teams. So Edwin, to your question, tune in next month, because I think that's going to be the specific topic, which is why I wanted to kind of end there today. And Ed, Stephanie, anything you want to just throw in 20 seconds before we wrap up?
Yeah, we both just shared in the chat. So I put a link to the discussion on Guild for today's session. And then we also have De-risking a Risky Process, a masterclass on new product development coming up next month. That's with Rob Restagno at Sterling Wood Group. So it should be a really good session. We encourage everybody to check that out. There's a link in the chat for that as well. And it's also on the renewed.net website.
And that is limited attendance. So if you're interested, you want to sign up soon.
I signed up already, so I'm good on that one. Are you redoing the marketing session with you know, the marketing crew from the set? Is that scheduled yet?
We are, yeah. Thank you for reminding me of that. That one is going to be on October 13th. So we're getting a Zoom link ready. We're actually going to offer it free to the entire Renewed community. So we'll send that out. It'll also be available to register on the website. So it was a really great session that nobody got to hear at the conference on niche marketing and marketing best practices. So that will be coming up soon. And all of the recordings to the conference sessions are in process. We should have that available within the next week to everybody that registered for the conference. They will get free access, and anyone that did not register will be able to purchase access to those. So a lot of really great sessions that you can hear the entirety of on the website. So we will be sending emails and announcements and posting in Guild when all of those are available. There's also a cool new feature in Guild for events. So that's a really easy way to see all the things that we have coming up. So check that out.
Great. Okay, thanks everyone. Good to see you all. Hope end of September and October is a spectacular month. And we'll see you in the future. Good
Thanks,
wishes.
David. Thanks, Ian. This was really great. We appreciate it.
Thank
Thank you
you.
very much. Cheers, bye.